Hey, what's up with you guys? So today I want to introduce you to a new concept, which is called the max pain pricing of options, and that's a theory. We're gonna discuss about that. It's a slightly different topic compared to liquidity providers, Liquidityfolio, but I hope you're gonna join that as well. So to introduce the topic, I prepared a few pages, and I want to start with just showing you the latest kind of price action of Bitcoin in the past few months. Now, if you look at the kind of the price trend, you see that as if the price of Bitcoin in this case increased or had a surge during the month, and then tend to in this case kind of decline, or let's say converge to a specific price toward the end of the month, and more specifically toward the last Friday of the month. Right, so there are kind of two questions here. I mean, this has happened, for all the 2021, but also November, December. There are kind of two questions here. So first is, what is that is so special about the last Friday of the month, and second is, what is this price that at which Bitcoin but also Ethereum seems to be converging at this date, right? So the thing about the last Friday of the month, in general Fridays, is that Fridays are when there is typically the largest amount of options expiring, the option contracts. Every Friday of the week, there is typically, compared to the other day, a peak in the options. And then the last Friday of the month is also higher volume. And then the last Friday of the quarter, even higher volume. The last Friday of the year, even higher volume again. And that's true for Bitcoin. It's true for Ethereum. For example, here we see the number of options expiring on the 30th of April, which is basically the end of April. And compared to the other Fridays, it still is way higher. And so that's it. Kind of explains why Fridays are an important date. And then I want to talk to you about this max pain pricing. But before doing that, I want to kind of give you a real example and remind you how option work, maybe for some of you who may not be that familiar with options. So let's imagine that today the Ethereum price is around 2,000. In reality, it's a little higher, but let's just imagine to make a number easier. And then Joe buys a call option, which is a contract whereby Joe, at the expiry date of the option, is guaranteed to be able to buy 1 Ether for a certain price. So let's imagine Joe buys a call option as so-called at the money, which means like the strike price of the option is 2,000, same as the price of the asset today. That expires on the April the 30th. And let's imagine also that Joe pays $100 for the option. So meaning, like, Joe has this contract, and if the price, by the end of the month, the last Friday of the month, is, let's say, 3,000 or higher than 2,000, Joe is still has the right to purchase the one Ethereum if you bought one option at the price of 2,000. Now let's consider two scenarios: scenario A and scenario B. With the scenario A, let's imagine that the price, at the expiry, price of Ethereum is $3,000. Now, the value of the Joe's option is $1,000. Why? Because you can buy for 2,000 and sell it for 3,000. And the market maker, by which I mean whoever sold the option to Joe, is actually losing $900, right? So he's losing actually $1,000, but he also earned $100 for the option. So he's kind of, let's call it, he's losing $900. So that's a kind of a loss for the market maker. Versus, let's consider scenario B, where the price of Ethereum that date, right, that day of the expiry, which is April 30, happens to be $2,000. Now, the value of the Joe's option is actually zero, right? Because it's, as they say, the option is expiring worthless. Because whatever, you can buy 2,000, but it also, the price is also 2,000, so it doesn't have any value. And the market maker is still making $100. That was the price of the option. There could be even a scenario C where the price, the closing price of Ethereum that day is even lower, and the market maker is making even more money. But this is kind of just to summarize possible scenarios. Now, let's imagine now that the relationship between the market maker, whoever is selling the option, and the retail customer or whoever is buying the option is not a one-to-one relationship. It's a relationship one-to-many, right? There are many buyers, many sellers, but also many, many buyers. And so what is the, this max pain theory? If you Google it, it's basically saying that the option sorry the price of the asset will tend to gravitate toward the price at which the market makers basically make the most profit, or the option holder makes the biggest loss or the biggest pain, right? That's why it's called max pain price. And this is at the expiry date, right? So that's why we are looking specifically at the expiry date of the 30, for example, 30 of April, or the last Friday of the month, because that's when there is a lot more volume of options. And in the past few months, in general, the volume of option for Ethereum, for Bitcoin, grew a lot, and so this is becoming even more in a sense important. So what I did, I went on Deribit, which is one of the biggest markets for options, and they sell options for Bitcoin, Ethereum. You can see basically, for example, if we take the expiration of the 30 of April for Ethereum, there's all the kind of the pricing here. And I created a couple of Excel sheets where basically there's one for Ethereum, one for Bitcoin. You can put in a date. In this case, is the 30 of April, the last Friday, and it basically calculates the maximum pain price for you. So based on all the call option, all the put option that are expiring on that date, it kind of calculates what would be the price at which whoever bought the option is making the biggest loss, or the market makers are making the biggest gains. And so for Ethereum right now, and by the way, consider these prices, they do change all the time. They don't change as frequently as the market price, but they do change. So what I'm telling you right now may be different, slightly different in a week from now. But basically, right now, the max paying price for Ethereum is around $2,080. Let's say $2,100 for simplicity. And the price of the max paying price for Bitcoin is around 56,000. So this is to say that the price used to be higher, and now 55.5. We don't know where it's gonna close, but I wouldn't be too surprised if the price of these two assets, get aligned in a sense with the max pain price toward the expiry date, which is the 30th of April. So that's kind of the theory. I hope this was informative. It was interesting to watch. If you have any question, feedback, I know this is kind of a lot of moving parts. Feel free to reach out to me directly. You find all my contacts in Liquidityfolio. You can reach out on Telegram or on Twitter. You find my handle right here. The DMs are open if you have any question. And again, I'll also include the links to these two Excel sheets. These are Excel sheets with macros because they're getting data from Deribit. By the way, this is a max paying price calculated on Deribit, but we assume that since Deribit is a very big option market, is it's probably a representative of the contract positions across also the other markets. That's kind of an assumption. But I'll include links to the sheets. And if you have any question, thoughts, feedback, reach out to me and consider subscribing to the channel. Until next time, have a great day, guys, and talk soon. Bye bye.